Next that will be discussed is incorporating a sole proprietorship or a partnership. Incorporation from a sole proprietorship or partnership is somewhat similar to that discussed in the formation of a partnership, except a few changes here and there, but regardless of their differences, the process is similar. A sole proprietorship or a partnership may decide to incorporate in order to enjoy the advantages of being a corporation. The books of the old organization may be used after giving effect to the changes, or a new set of books may be opened. This is the common practice to open a new set of books. Incorporation when the old partnership or proprietorships are retained and used. First, what's needed to be done is to revalue the net assets of the partnership. Adjustments in asset and liability balances may be reported through a revaluation account called capital adjustment account, or recorded directly to the capital accounts of the partners. Next is to recognize goodwill if there is any. Next, in case a revaluation account is used, we have to close the balance of the capital adjustment account to the capital accounts of the partners in accordance with their profit and loss ratio. Next thing to do is to record the authorized share capital of the new corporation. Next is to record the issuance of share capital to the partners. Then record any necessary distribution of cash to partners. And lastly, record the issuance of share capital to other incorporators or shareholders. Then next is the incorporation when new books are opened for the corporation. These entries are prepared in the partnership books before opening the new books. First is the revaluation of assets, the recognition of goodwill if there is any, the closing of the capital adjustment account to the partners' capital accounts, the receipt of share capital from the new corporation, the distribution of share capitals to the partners, and the distribution of cash to partners if there's any. When the new set of books are being opened, these shall be recorded in the corporation books. First is the authorized share capital. Next is the issuance of net capital for the net assets transferred by the partnership. And third is the issuance of share capital to other incorporators. To further understand this, here is illustrative problem A. Roberto and Remedios are partners sharing profits and losses in the ratio of 3 to 2. They decide to retire from active participation in their business, so they form a corporation to take over the net assets of the partnership. The statement of financial position of the partnership just prior to incorporation on January 1, 2014 is presented below. Roberto and Remedios Partnership, a statement of financial position as of January 1, 2014. The corporation is organized as Winner Corporation and is authorized to issue 10,000 shares of ordinary share capital, par value 10 peso. 25,000 shares were sold for 20 peso. The corporation takes over the partnership assets other than cash and assumes partnership liabilities in exchange for 12,000 shares. The following adjustments are to be made before taking over net assets. First, the inventories are to be stated in their market value of 45,000. Next, the allowance for uncollectible accounts is to be increased to 5,400, and the equipment is to be recorded at its current value of 120,000 pesos. The ordinary shares will be distributed as follows: Roberto 9,000 shares, Remedios 3,000 shares. Cash will be distributed based on the capital balances of the partners after distribution of the shares. Ordinary share capital are selling at 15 peso per share on this date. This problem is with the assumption that the old books will be retained. So first, as I have discussed, is to revalue the net assets of the partnership. The first adjustment is to record the merchandise inventory in their stated market value of 45,000. Now, the entry to record such adjustment is to debit merchandise inventory for 19,500 and to credit Roberto Capital for 11,700 and Remedios Capital for 7,800. 19,500 is debited in merchandise inventory because merchandise inventory, as stated in the statement of financial position, is said to be 90,000 25,500 pesos. So, since its stated market value is supposedly 45,000, in order to increase the merchandise inventory account, you have to debit it. 19,500 will be distributed to the partners' capital at their profit and loss ratio of 3 to 2, which is 11,700 and 7,800 respectively. Next adjustment is the allowance for uncollectible accounts is to be increased to 5,400. And the entry to record such transaction is to debit both Roberto and Remedios Capital for 1,440 and 960 respectively, and for allowance for uncollectible accounts as credit for 2,400. Now, since allowance for uncollectible accounts is a credit balance, and it is said in the adjustment that it should be increased to 5,400, yet the previous amount was let alone 3,000. In order to increase such account, you need to debit it for 2,400. This 2,400 is a decrease to the capital of the partners, which is yet again distributed with their P&L ratio of 1,440 and 960 respectively. Next adjustment is that equipment is to be recorded at its current value of 120,000 pesos. Now, the entry for that adjustment is debit accumulated depreciation of 30,000 with a debit of equipment of 30,000 and a credit of Roberto and Remedios Capital for 36,000 and 24,000 respectively. Now, current value means that it is the actual amount of that asset on that date, meaning it is already depreciated at that amount. So in order to get to that amount of 120 for the equipment, accumulated depreciation was debited because since it is a credit balance, in order to close that or write that off, it should be debited for 30,000. Equipment is debited for 30,000 because the value of equipment in the statement of financial position was 90,000. So in order to increase that, 30,000 should be debited to the equipment to increase the value to 120,000. The total of the debited accounts would be distributed to the partners in their P&L ratio with the amounts of 36,000 and 24,000 respectively. Next step is to record the authorized share capital of the corporation. Since memorandum entry should be used, the entry to record such transaction is to state authorized to issue 100,000 shares of 10 peso par value ordinary share capital. Third is to record the issuance of share capital to partners. The entry to record such transaction is to debit Roberto Capital and Remedios Capital for 135,000 and 45,000 respectively, and to credit ordinary share capital and Remedios Capital for 120,000 and 60,000 respectively. Next is to record the distribution of cash to partners. The entry to record such transaction is to debit Roberto Capital and Remedio Capital for 13,500 and 31,500 respectively, and to credit cash for 45,000 pesos. Next is to record the issuance of ordinary shares to other incorporators. The entry to record such transaction is to debit cash for 500,000 and to credit ordinary share capital for 250,000 and ordinary share premium for 250,000 as well.